Welcome, everyone. My name is Blake, and I will be your moderator. Tonight, we're joined by Senior Director of Transition Services, Dr. Thomas Snyder, and two renowned legal and financial experts, Scot Crow and Mike White, for part 2 of this 3-part series. Before we get started, I'd like to note that Henry Schein is not offering CE credit for viewing or attending this presentation live or on demand. Welcome, and thank you for being with us tonight. I will pass it over to you now.
Hello, everyone. I'm Tom Snyder, Senior Director with Henry Schein Dental Practice Transitions, and we're glad to be with you again for our second webinar in the 3-webinar series about DSOs. Some of you may have joined us back in November for our first program, and tonight we're going to cover some new ground and get a little more in depth about DSOs. What is a DSO, and do I need to establish one? So before we get started, I'd like to introduce my colleagues for today's program, Mr. Scot Crow and Mr. Mike White. So Scott, let people know who you are.
Good afternoon, everyone. My name is Scot Crow. I am an attorney at the law firm of Dickinson Wright. I've been practicing north of 20 years now and have been doing dental transactions for about that length of time as well. It's a pleasure here to be here with everyone, and hopefully we share some thoughts with you today that you find valuable.
Mike.
Yeah, no, I appreciate it. And it's hard to believe that we did the first webinar 2.5-3 months ago now. It's almost February. But yes, my name is Mike White. I'm a principal at CLA. Excited to do this educational broadcast again. One of the leaders here at CLA. I've been in the dental industry about 14, 15 years now. I've been practicing public accounting about 19, and really try to build a team around of CFOs and consultants that have ranged from 300 to 400 locations of knowledge base and helping the industry continue to grow and what's going on. So this should be a good discussion today.
Well, thank you very much. Okay, let's get started. Well, consolidation in dentistry is nothing new. We have other healthcare professions that have preceded us, and they're pretty much complete. However, dentistry, even though we've been consolidating for probably 20 years, Scott or Mike, you can confirm whether that's about right, but we're still, I guess you could say, in the relatively early stages, because some of the statistics I'm going to share with you will kind of attest to the fact that there's still a lot more mileage to go in this highway of consolidation. So a couple of points I wanted to talk to you about briefly. Still, believe it or not, that even though we continue to grow with large group practices, most of dentistry is still performed in single practice locations. And however, we've seen a lot of changes. For example, as of 2021, the ADA's Health Policy Institute reported that only 46.2% of dentists were considered solo practitioners. That ratio has decreased greatly when about 15 years ago, 67% were considered solos. In 2019, only 1 in 4 dentists under the age of 35 were in solo practice. So we're seeing a big sea change with younger practitioners. And of course, as those of you who are now in the multiple location space, you're finding that you're having a hard time recruiting and retaining dental staff. For example, the whole profession since COVID has experienced shortages and difficulty in hiring dental hygienists and dental assistants, and in some cases, associate dentists. If we look at US locations, United States, look at group practices, large group practices of over 50 plus locations, about 5.9%. That represents about 9.5% of dentists. If we look at the small multi-location groups, which we characterize between 2 and 49 locations, that's about 25.7% or about 26% of all dentists. So I would assume that many of you on this program tonight probably fall into that category of 2 to 49, or maybe you're still a single entity and you're thinking of going to the next level. But you can see 68.4% are still unaffiliated single location practices, which is about 65% of dentists. So as I said earlier, consolidation is still going on and there's a lot of room to grow. If we look at small group practices by location, by meaning number of locations, and this data came from Dental Market IQ with a webinar they presented recently. This data is current as of October 2022. So we see for the 20 to 49 locations, there's 76 dental groups. But when we look at the 5 to 19 locations, we have over 1,100 dental groups. 4 locations, 783, 3 locations, 1988, and 2 locations, close to 14,000 dental groups. So you can see there's a lot of variation and a lot of questions that many of you may be considering, and hopefully we're going to answer some of those today. There is a new generation of dental graduates now, and they look at things differently than when folks like me entered the profession, where the majority of us wanted to be business owners. But that's been changing and changing radically. We see that ownership rates in private practice have been declining. In 2005, roughly 85% were dental business owners. In 2021, that number decreased to 73%, and it continues to drop. And 1 in 5 dentists under the age of 35 are affiliated with a DSO. So going into the future, with less dentists aspiring to be business owners, there's going to be a pretty ample supply of doctors who can work in this group practice environment. Okay, so now we'll get started with some questions. We have a number of questions we put together that hopefully we're going to address tonight that give you some insight into what's going on. And so the first question I'm going to direct to Scott. So what makes a DSO a DSO?
It's an interesting question. It's really 2 different facets. One is in the legal sense, the dental service organization is a bifurcated structure where you have the management company sits outside the PC. So you have the professional corporations that are owned by the doctors enter into agreements with the management group that then draws the profitability out of the professional corporation exchange for the provision of services. But in its truest sense, DSOs come in all sizes and shapes, and there's no single set example of what exists. If you canvass all the larger players in the country, they all have nuances inside of their DSO structures and how they partner with their doctors. And that's really where the differences lie, is how are they actually partnering with the doctors that are providing and producing the revenue on a daily basis. But what it really means is you've got a centralized management team. A DSO is where you create a centralized management group that has your management level employees, meaning all of your non-clinical individuals are centralized in providing services across the board to all the professional corporations that exist as part of that network. That doesn't mean it has to be legally set up as a DSO. You could have a single practice that has a large management group that is providing management services to other practices. So again, it comes in all shapes and sizes, but what it really means is centralized management. Because if you set up a DSO structure and you're aggregating professional corporations together, so say 2 or 3 local groups come together and they decide they want to form a DSO. Without centralized management, you may garner a bigger multiple just because you're putting and posting a bigger revenue number, and more importantly, a bigger profit number on the scoreboard. But really, if you're looking for premium pricing, DSOs or private equity groups that are looking to acquire are really looking for a management group that is able to take on additional professional corporations. So there's one thing to call yourself a DSO, but really it's not the legal structure that makes you a DSO. It's the centralized management function that really creates that DSO structure that's often referenced.
And I think that's so, just to add on that, I think that's so critical, because I know Scott's met folks, I've met folks, Tommy probably have as well, that, say, oh, I have my DSO set up. And so I ask for the legal documents, they may or may not be there, but then I go look into financial records and they've done nothing to follow the path of what the DSO laid out to stay in compliance, to manage the service agreements and do all that stuff. So it's as important of setting up the structure and getting the legalese right as it is implementing that DSO to get that valuation that Scott was referencing, in his conversation.
Great, thanks. So
Mike, I'm going to direct this to you, and I know we touched this in November's webinar, but I'm sure there's a lot of people on tonight's program that did not attend. So we're going to be a little redundant with a couple of things. And the first thing it is why and how is EBITDA calculated during acquisitions?
Yeah. Well, hopefully this conversation gets them to go back and watch the first one. So, this is such a great conversation, right? The short answer is, what is EBITDA? Earnings before interest, taxes, depreciation, amortization, right? In the simplest form. What does that mean in the hands of a buyer, and what does that mean in the hands of a seller? What the buyer is looking for is truly, what is the net earnings that they're going to leave behind? What are they acquiring? So in the simplest sense, using big numbers and simple numbers, if I'm the producer, my net profit's $1 million, but that includes me, doctor production. So I'm going to take $400,000 out to continue to practice. Then you're selling $600,000 of EBITDA, right? Not the full million, which is what I've heard so many times before, from that conversation. But I have $1 million profit, but you have to still get paid to do production as a provider and all that stuff. So what's critical and how we summarize it is, it truly is what is being left behind for the buyer to acquire. The other fun part of this, and we all know this, is the perception of a seller's EBITDA and the perception of the buyer's EBITDA is often different. You try to get there as closely as possible, but it becomes a negotiation of what truly centralized services do they already have in place as a buyer. What do you have on your team that may be redundant or may gain efficiencies in the hands of the buyer? So those are all things you're trying to understand from that buyer's perspective as a seller, and all things you want to know to maximize your valuation as a seller to that buyer. Hopefully I didn't say all those words too many times. So
No, you didn't. So, hey, Scott, would you say, with all the years you've been in this space, do most of the DSOs calculate EBITDA pretty much the same, or are there variations to that?
Well, the answer is yes. I mean, it's a gap-based calculation, so there's not a lot of variation in the methodology that goes into what is EBITDA, but there is the concept of adjustments or add back. So what truly falls into reoccurring expenses versus one-time expenses, parties can have very different viewpoints on what that means or whether it should apply or not. That's often part of the negotiation. Sometimes you get to see the seller's or the buyer's calculation of EBITDA and how they got to there. Oftentimes they will not share their full quality of earnings report or review with the potential seller, because there's often other things in that report that they're not wanting to or willing to share. In other words, the synergies that they're expecting to pick up an additional value, which offsets some of those items. The thing that really varies on a DSO to DSO basis from a valuation standpoint is, and you see this a lot in an auction process where buyers come in and they're bidding, often have very different viewpoints on the multiple that should apply to that EBITDA. And EBITDA and multiple are just common sense ways of portraying to a seller what really is a present valuation of cash flow analysis that they are then converting into an EBITDA calculation. So having the conversation on the first would be very difficult for a seller to understand, but an EBITDA times a multiple is something that they can get their arms around, can be customary in the marketplace. So that's where you get the variations. But in general, yes, EBITDA is pretty much calculated generally in the same fashion by all parties, not just in the healthcare sector, but really across the entire financial industry for buying and selling businesses.
Great. So I'm going to
Tom, one thing we're starting to see, real quick, sorry. One thing we're starting to see more, and Scott kind of referenced it, the buyer is going to be doing due diligence through a quality of earnings, depending on size, quality of earnings light or a full scope. We're starting to see more and more sellers be diligence ready by going through their own sell side quality of earnings through the process to find those skeletons, have the discussions, look for those add back adjustments that the buyer may or may not give them credit for, but they're ready to have the discussion, especially when we get those opportunities and we're seeing the financials may not be in as good of a shape as they should be in that diligence process, which is a driving factor in telling the story for your financials.
So yeah, it's a very good point, Mike, that anytime I have a new client that comes and they're looking to either get an investment banker engaged or they're talking about selling their company. It doesn't matter what the industry is that they're in. My speech to them is always the same. Have your lawyers come in and do your legal diligence, and have your accountants come in and do a quality of earnings analysis. And if they're not capable of doing it, find someone that is, because the I don't want to call them games, because they're not necessarily games that are being played by private equity. When they're making an offer to acquire your practice, they're doing it based off the financials that you have produced. So they're unadjusted, untested. They're taking them at face value. And you have an LOI that you sign, and there's usually a purchase price adjustment in there, either upwards or downwards, for the quality of earnings analysis. When you go out and get your own QOV and your financials are based off of that, you have a less likelihood of getting an adjustment, because you've had someone of the skill that's able to produce that earnings analysis that should come back relatively comparable. They often don't come back apples to apples, but they're much closer. And it also gives you the ability to bring in your accountant, that if they come back and say your earnings are X when you portrayed Y, and you start to dig into how did you get there, you've done your homework, so you're not caught with your, so to speak, pants down, where you're unprepared to have those conversations. So if you're really looking to protect your purchase price, which is why you're entering into this transaction to begin with, you should be doing the legal diligence, and you should be doing the financial diligence, because those are the two things that don't always kill a deal, but they will certainly affect price.
So, gentlemen, quality of earnings, for those folks who haven't gone through it, is it similar to an audit, and is it what's involved? It sounds like I know it's a pretty big deal. So maybe just give our viewers
quality of earnings, it's actually quite different than an audit. We're actually seeing more and more bankers utilize it in lieu of an audit as they start going through their own underwriting process as well. We are testing some things, right? We are doing, it depends on the scope of the engagement, but we are testing revenue procedures, so cash proof. So the deposit, you said you hit the bank, actually hit the bank, hit the client accounting file, and hit the practice management system. So we're making sure all those things tie out. We're understanding what the payroll procedures are, what the rent schedule is, any of those, add back items, saying, hey, I ran my boat through, my car through, and all my vacations. So we're going to take all those adjustments, have you justify them to us as those advisors, and say, yep, there is support for this. This will not be recurring in the hands of the buyer, and trying to, I'd say, plead the case for the seller to be able to represent those add backs as an adjustment. So it truly is. It is justifying the earnings or qualifying the earnings of that organization. And when we do the buy side, as Scott just mentioned, as the buyer, we're going through and trying to pick apart and tell the story. But if we're getting bad financial data, if we're not getting, data, if you can't tell us the add backs or adjustments, we're just going to assume they're not there, and we're going to give you a less than valuable EBITDA because we can't figure it out ourselves. So you have to be able to work with your advisors on the sell side. You have to be able to know your financials intimately enough. We can't stress it enough in transactions, miscoding something, not doing your accounting properly. When we're talking about a multiple, if $1,000 miscoding, it's now maybe $7,000 valuation impact. Take that to 100,000. Now it's a $700,000 valuation impact. So those numbers really add up fairly quickly. And so many times when we're talking about it, it's like, look, invest in your financials, invest in your legal structure. You're going to get the return on that investment.
Great. Okay, so let's switch gears now and talk a little bit about our economy. And of course, we've heard lots of people say, we're going to have a recession. We may have a recession. It's a hard one. Is it 23? Is it 24? When and if it does occur, will that have an impact on consolidation activity? And if so, to what degree? Whoever wants to go first, want to take a shot at it? Mike?
Yeah, I'm happy to. And I know, Scott, we're going to have a similar, what we're seeing, we haven't seen the impact on the valuations thus far. That's not saying we won't, right? A lot of these deals are debt financed on the back end. So you have rising interest rate costs, valuation costs. That's going to impact that valuation. What we're still getting is a little bit of carryover from COVID, where all these private equity investors had money and had balance sheet cash to burn and get deployed. So they too could get the return on investment from that structure. When that runs out, when that tips over, Q1, Q2, I don't know. Depends on what does happen with these recessionary indicators. One day it's bad news, doom and gloom. One day it's great news and things are still looking up. So, we're still seeing transactions getting done. And for those buyers that we've been working with, and same with Scott, for years and years, they're still buying. They're just looking at things harder. They may be saying, okay, we'll give you a little bit of credit here, but maybe it's in a deferred comp structure because you got to prove those add backs. Maybe it's, something along those times from a term structure. Maybe we won't give you as much rolled equity value as we would have before. So things are going to change that way, but there's still activity happening today.
Yeah,
Scott?
I agree with that. It's interesting. After COVID, I've actually, and like maybe you've seen this, maybe you haven't, is especially for the 1 and 2 location practices, multiples have actually crept up a little bit, that they were getting a higher purchase price, which means there's, if you're reading the tea leaves, it means it's a relatively competitive environment out there for well-run practices. And that likely will continue to be the case regardless of recession or not. This industry, the one thing about it, if you look back over the history of it, it is relatively recession proof, particularly if you're operating on a group basis, because you can diversify away from particular geographic or owner instances where you have a stressed owner or a stressed geographic region. So I think they'll continue to be acquisitive. I think PE is, still gathering funds, still packed with cash. They have fuses on that money, so it has to be spent at some point and deployed. So yes, I agree with Mike. I think you'll continue to see consolidation. What you do see differently, though, that's developed over the last 5 to 10 years is this hedge against, we paid X for the practice based on this level of production. And if that production dips or profitability dips post-closing, then we're going to take it out on the seller. So you sold us X amount of revenue. In exchange for that, we expect you to enter into a contract to work for us for X number of years and fulfill that contract. And to the extent you don't, we will claw back some of the purchase price, usually in the form of equity that's taken away from you. And also, if you come on board with us and you don't hit the profitability numbers, we'll also claw back that equity. So usually that equity was only risk if there was some sort of damage claim, an indemnity claim, that something you told them about the business was untrue. But now there's this peek into the future of, if you don't, then we've overpaid for the practice and we're not willing to pay that price. So that is definitely something I think that's here to stay. I see it in the other medical sectors outside of dental. And I just don't see that trend going by the wayside anytime soon.
Great. Okay. Mike, we hear the terms DPO, HSO, and SPO being bantered about. Are there any differences in these terms? Is it just nomenclature?
Yeah, I've heard DMO. I've heard all sorts of nomenclature, and I'm not saying there may not be some variations to the model. Ultimately, when you're meeting with somebody, some people say the DSO term has gotten a negative connotation, so they're trying to, market against that and make sure that people are comfortable. They try to make some slight variations into their model and how you're buying in and running alongside, maybe have a little more equity on the roll. And so they give that a different name so they can change themselves in the conversation and say, well, we're not like DSOA, we're a DPO, but you really have to, from a mathematical standpoint and a legal standpoint, really walk through, what does my life look like? What are they taking over administratively? What are they taking off my plate? What's their vision for the future? What's the next turn life like? Are they planning on taking another private equity event here in 12 months? Are they 3 to 5 years? Are we early in the phase? So maybe I get more equity. There's a lot of things for you to think about other than the nomenclature of what they're marketing to you. Really, what is it that you're buying into or selling to within your practice?
Makes a lot of sense. Cool.
Love to hear Scott's take if he writes his documents any differently.
Not that differently to begin with. It's all optics. But if they, if it quacks like a duck and acts like a duck, it's a duck.
Yeah.
There you go. So Scott, when is the right time to organize as a formal DSO? is it based on practice size, number of practices already in place, or other factors?
I get asked that question a lot, particularly with new clients that are looking to grow. And the answer I give them is the one I'll give here, which is it really depends on your intent. Because I like to start with any structure, whether it's even if you land on the DSO structure, there's even nuances within that. So if they say they want a DSO, it's really what's your end goal? What are you looking to accomplish? And then you kind of work your way backwards from there. And when you work your way backwards, you can figure out as a group, does this make sense to make the investment to convert to a formal DSO today? And if you want to, what are the hurdles? Oftentimes these practices, someone will come in with 4 practices, all been individually financed. Well, you can't necessarily create a DSO structure without bank consent or without refinancing all those assets. And oftentimes they don't want to do that. Or you have groups that come together and say, hey, we want to form our own DSO in the city of Columbus. And again, debt will restrict them from doing so. And they're not really while they talk about forming a DSO, once you explain to them what the realities of what it will mean on a go-forward basis, and there's different variations, sometimes they lose appetite. Sometimes they'll pivot to doing what I call a DSO light, which is not moving their assets, not commingling, but really entering in and forming a management company and moving the employees over, which is an unwindable type of structure. So you move your employees over, they act as centralized management. And then if a group decides to break away, they could, and they could take their employees back. It's a way to test and see and get used to what a DSO is, as opposed to jumping in. And as Mike said, if left to their own means, you go back a year later, you typically will find a mess, is what you'll find, that they didn't fully understand what it really meant to be a DSO. So the legal and accounting can always be ahead of really the practicalities of building a team and who are the key persons that you need to run the organization. So it's always with the end goal in mind as to whether a DSO is right for you now or in the future.
Great. Okay. Mike, what's the best investment a small group can make when preparing for a transition to the next level of operational size?
Yeah, no, I'm going to say financials, right? I of course, being a CPA kind of guy, but I think I'm going to build off what Scott said earlier. You know, whether you're forming a DSO, again, depending on what your lifeline, if you're forming a DSO to sell and transact now, most likely the buyer has a DSO already, so don't spend that money and invest to then just revert back. But spending the money and making sure your financials are in good working order, you're telling the right story, you've added back and gotten some of the noise of the personal expenses out, you understand the semantics of your business, and you've looked for those opportunities and savings and supplies and staff and marketing and lab and all those areas that we all talk about from that standpoint. But the most important thing, I don't say the most important thing Scott said, but one of the most important things Scott said, it truly is, how are you acting as an organization? Whether you're formally a DSO, you're a management company, a DSO light, or just multiple practices working together, how are you interacting? What are those service agreements saying? How does your business flow? Are you allocating the expenses across practices? Are you tracking revenue? Do you have the bank accounts? Do you understand what services you are offering? Centralized billing, scheduling, accounting, IT, HR, any of those functions. And what does that mean to your organization to truly have somebody be interested in taking you to the next level? Or even if you're in that stage where you're growing your DSO yourself or your multi-group location, the banker is your investor. What are they looking at you for from a lending perspective? Do they want to give you money and bank on you to be successful as you grow your group?
Okay. Maybe along with what you just said, if it's a small group, when do you maybe consider going to a centralized building and use of a call center? Is it based on size of the patient base, number of locations, staff? Is there not a straightforward answer?
From the financial perspective, there's a lot of things you can centralize, a lot of things that you can outsource from the function, whether it be revenue cycle management, whether it does accounting or IT or legal. I know Scott acts as a fractional lawyer, as we act as a fractional CFO to many of his clients. Those functions, as you're looking at the inflection point of your growing organization, if you're 3, 4, 5 locations, I see so many people go to a conference and say, oh my gosh, I heard about somebody built their call center out. I need to go do that. Well, it may be $1 million+ investment. Are you really wanting to do that? And do you have somebody truly to run it? And are you going to add value for it? You know, truly you have to look at what your goal is. If your goal is to get to 10 locations and transact, try to do it as lean as possible. If your goal is to get to 10, 15 locations, go get lending and get to 20, 25 locations and keep building the story, then we start talking about when's that inflection point? What's the first thing you bring in-house? When do you bring on that first regional manager, director of operations, CFO, CEO, things along those lines to help you continue on that stake? It really becomes each DSO or DMO or DPO. They have a story to tell, and you have to kind of work with them on when do they interject those pieces.
Great. Cool. Scott, if a small group has various lending sources, should they be consolidated prior to going to the next level?
Typically, it's kind of an interesting thing, and I've had some new funds that have popped up in this sector with this general concept is oftentimes groups will take on private equity and they're just not ready for it. They don't have a sophisticated enough CFO, which is really if I were to pick all the people in the organization, that's probably the most valuable to getting to the next level, is having a CFO that understands KPIs, understands the financials of the business, because if you are looking to go to the next level, you want to kind of make sure that structure is sound and efficient and clear and, unchallengeable for the most part. Your audits are going to come back clean. So if you're getting ready to transition up, yes, I think it is a good idea to consolidate your debt, get a good debt package in place, and if possible, get an accordion feature. And with a good CFO comes the elimination of personal guarantees. Because when a bank can trust that your numbers are there and you have indicators in place that you can track and understand and you actually react to, it'll make them feel more comfortable with their lending packages. So it is a good idea to consolidate the debt, get yourself cleaned up. And kind of the pre-private equity is a group that would come in, take a minority position, but they're often very hands-on. And I don't mean hands-on necessarily from the day-to-day standpoint. They're just more accessible, and they can help you find people to help round out that team so that when you do go to market, you're going to protect your value as much as possible from a dilution standpoint. And this comes from a number of CEOs that rushed to do deals. And while they saw the value of the company explode into, in often cases close to $1 billion, their net take at the time of retirement was nowhere where it could have been had they been patient, taken time to put those systems in place, and gotten a better valuation when they first went to market. And those that don't, you end up suffering that, that accretion in value. It goes to the bank and not to the founder of the company. So it's a super important thing to be cautious of before you approach actual private equities, making sure that you've perfected your model.
Very good. Mike, how important is having a combined or integrated software program when contemplating an acquisition by a larger DSO?
No, there's a lot of ways to aggregate data. So if you've been acquiring practice and you have disparate systems, you're working with Henry Schein version, 10.2 and 16.4, then you went to Schein Ascend for the new practices, then you overlaid the Jarvis Analytics, as long as you can get the data out of the various systems and you have a process around it. The biggest challenge we see when doing quality of earnings and from a diligence standpoint is these systems, if we don't put procedures in place to close the procedures and close those days, then we have post-period adjustments happening. We have the front desk making changes to something that happened 2, 3, 4 months ago. So we're providing reports that are changing on a day-to-day basis, week-to-week basis. So, getting that consistency in reporting is so key. Now, as analytic systems and data and all that kind of stuff that is out there today, what's critical is what are you doing with it? I have so many people that have, I have the latest and greatest analytics tool. CLA, we have our own tool as well. But it's like, well, who's looking at the data on a daily, weekly, monthly basis, and what actions are they taking with that data? There's a lot of great data to run a business, but to Scott's point, that CFO, that finance team, to be able to deploy actions, work with the operations, work the front desk, work with the provider, and really understand how to move the needle in that practice and maximize the scheduling utilization, maximize the patients and the fee reimbursements. It's so critical to be able to deploy all that. The last thing I'll say on that is make sure when you're looking at your practice management data, your doctor days work, production per patient, number of patients seen, make sure you're correlating that back to your P&L. So if my collections for my practice management say 100,000 and my QuickBooks file says 80,000, what happened? Is there a timing difference? This could get back to your billing procedures. How are we depositing money? When does it happen? How are we receiving it? Things along those lines. So make sure all those systems are really talking and interacting and somebody's measuring them against each other.
You really shouldn't, regardless of the software platform, I think the more important thing is having access to real-time information. If you're waiting a month to see your financials, you have no way of really being able to manage or impact your company or the profitability on a weekly basis. You're coming a month in behind. So it's really important that you have that piece of the puzzle.
Super.
And still to this day, Tom, the sad thing is most people I see when the financials are 90 days behind, 110 days behind,
Wow.
Still to this day. So getting to monthly is the first goal. So, but I absolutely agree with Scott. When you get to that next level, they're looking at, first drafts 5-10 days after month end, 15 days, they're meeting boards and regional managers and all that stuff to make changes for that existing next month.
Your year-end results should not be a surprise to you.
Yeah,
Right.
That's right.
For sure. So we've heard the term regional administrator. What is that person, and when's the right time to recruit for this position? Mike, you want to take a crack at it first?
Yeah, it's interesting. I mean, we'll take not only the regional manager, operations manager, director of ops, and building off of the conversation. I mean, there's no school for regional managers, right? These are folks that have been internally grown within an organization. They used to be a really great office manager, or really good operations, or a really good, scheduler, any of those functions that you can do within a single practice. And they've just been elevated over time to say, oh, you're really good at this. Will you come help me at this next location? Will you come help me at this location? Oh, by the way, don't forget to look after the other 2 locations you used to be at as well. And before you know it, each regional manager is managing 6-7 locations. I've heard one regional manager to 20 locations at some of the bigger groups. But you really have to have that structure in place to be able to do that and make sure. The key to this is, talent, not just hygienists, assistants, regional, CFOs, COOs. It's all hard talent to find. We're training from other healthcare verticals. We're training from other retail verticals to teach them this industry, to bring them over there and help continue to grow this, because there's not a lot of talent out there that just has grown up doing this for the last 15, 20 years. So it's really a specialized thing, but if you have good people, invest in them, help them continue to grow and find out what their career paths are and what they want to do when they grow up, and make sure you're keeping them, because it's so hard to find new ones.
For sure. So, Scott, I have another question, winding down now. You mentioned a few minutes ago how critical it is to have a CFO, and a good one. What about having a CEO in place and a COO, and those positions, if they're in place, does that enhance the value of a group if you're going to be acquired?
I think the answer of whether you need, and Mike kind of alluded to this earlier, like I can go out and acquire 10 practices, get them consolidated, probably with 10 or fewer centralized management people. You have your CFO, maybe rev cycle, accounts payable clerks, and bookkeepers, like mostly that are on the financial side, because you're tracking and running those practices. So I'll go back to, it really depends on intent. If you're looking to grow and formalize into a DSO, and you're going to go out and do this pre-private equity, and you're a group of doctors that are doing chairside income, who's going to do that chairside if you're out trying to aggregate and buy practices? So what you end up doing, and I literally just gave this speech yesterday, is if you don't have someone that's helping you buy those businesses, and even if you do, you are going to spend a lot of evenings shaking a lot of hands and talking to a lot of people, because your doing your chair side during the week. So that leaves limited time to do the management side of your practice. And then also, in addition to that, go out and try to acquire structure, meet with your lawyers. It can be a drag. So if you're really aggressive about wanting to go out and get into a growth model, you definitely should think about bringing in a COO or a COO that can help drive those business initiatives forward. Otherwise, I don't know that it's from a value. Is it more valuable or not? It's overall, they'll look at a centralized management team. And really the question is, without putting more capital or investing in human capital in this business, how many practices can they take on? So we can buy another 50 practices with this management group. That's a more valuable platform with the exact same EBITDA, where the comparable is, well, we can only buy another 5 practices and they've reached maximum bandwidth. Well, I'm a buyer and I believe in both choices. I'm going to pay more for the one that can take on 50 additional practices without having to invest in the infrastructure of the business. So it's, I know I'm hedging the question, Tom, not really answering it, but again, it goes back to what's your angle of mind? And then you kind of work back from there. And sometimes goals change and you get to a standpoint, you fall in love with your company and say, I don't want to sell it. Well, then you're at a crossroad and you got to start to figure out, do I need a management team and where are my gaps and my blind spots? Because, in the short run, you can burn the candle at both ends for a few years, but after time, it's taking life off your years off your lifespan by doing that. And enjoyment and all the other things of balance that you typically want in your life are going to disappear. So it's a very personal question that gets answered.
Great. Good. Well, I think the folks that have joined us today are beginning to appreciate that this is not a cookie cutter business. There's no recipe that's strictly A, B, C, D. There's a lot of variables. And that's why we wanted to address as many things tonight as we could. Obviously, we touched a lot of points tonight, and I'm sure there are a ton of questions. And we don't want those questions unanswered. So we really encourage you to reach out to us. There's various ways you can do that. You can go to our website, henryscheindpt.com, or email at DPT, that's Dental Practice Transitions, at henryschein.com, or call our toll-free number at 800-988-5674. And both myself, or more importantly, Scott and Mike, will be very happy to chat with you. They're extremely knowledgeable, as you can see, and they really are here to help. So we encourage you to reach out and try to get some of your questions answered. In addition, if there are other areas you'd like us to cover in our next program, we would appreciate that. We want to thank you for taking the time to join us, and circle this date on your calendar, April 18th. We're going to try to drill down a little bit more deeply in some of the things that we covered, because this program series has been like a building block. So we look forward to having you join us again on April 18th. And I want to thank Mike and Scott for their time and their expertise, and really enjoyed tonight's program. So thank you very much.
Thanks, Tom.
Thanks, everybody.
Thank you so much for that wonderful presentation, and thank you all for joining us tonight. We did record the webinar and will email out the recording sometime in the next week. We would appreciate your feedback via our survey that will pop up on your screen shortly. Thanks again for joining us, and we look forward to seeing you on future webinars. Good night.